What is homeowners insurance? Homeowners insurance is a form of property insurance that covers losses and damages to an individual's residence, along with furnishings and other assets in the home. Homeowner insurance also provides liability coverage against accidents in the home or on the property. Understanding homeowners insurance. A homeowners insurance is a policy that usually covers four kinds of incidents in the insured property: the interior damage, exterior damage, loss or damage of personal assets, belongings, and injury that occurs while on the property. When a claim is made on any of these incidents, the homeowner will be required to pay a deductible, which is in effect the out-of-pocket cost for the insured. For example, say a claim is made to an insurer for interior water damage that has occurred in a home. The cost to bring the property back to a livable condition is estimated by a claim adjuster to be $10,000. If the claim is approved, the homeowner is informed of the amount of the deductible, say $4,000, according to the policy agreement entered. The insurance company will issue a payment of the excess cost, in this case $6,000. The higher the deductible on an insurance contract, the lower the monthly or annual premium on a homeowner's insurance policy. Every homeowner insurance policy has a liability limit, which determines the amount of coverage the insured has should unfortunate incidents occur. The standard limit is usually set between $100,000, but the policyholder can opt for a higher limit. In the event that a claim is made, the liability limit stipulates the percentage of the coverage amount that will go down towards replacing or repairing damage to the property structures, personal belongings, and cost of living somewhere else while the property is worked on. The acts of war or acts of God, such as earthquake or flood, are typically excluded from standard homeowners insurance policy. A homeowner who lives in an area prone to these natural disasters may need to get specific coverage to insure their property from flood or earthquakes. However, some basic homeowner insurance policy cover events like hurricane and tornadoes. Let's talk about homeowners insurance and mortgages. When applying for a mortgage, the homeowner usually is required to provide proof of insurance on the property before the financial institution will loan any funds. The property insurance can be acquired separately or by the lending bank. Homeowners who prefer to get on their own insurance policy can compare multiple offers and pick the plan that works best for their need. If the homeowner does not have their property covered from loss or damages, the bank may obtain one for them at an extra cost. Payments can be made towards a homeowner's insurance policy, and they are usually included in the monthly payment for the homeowner's mortgage. The lending bank that receives the payments allocates a portion of insurance coverage to an escrow account. Once the insurance bill comes due, the amount owed is settled from the escrow account. Now let's talk on the difference between homeowners insurance and home warranty. While the term might seem familiar or sound familiar, homeowners insurance is different from a home warranty. A home warranty is a contract taken out that provides for repair and replacement of home system and appliances such as the oven, the water heater, the washers, and the dryers, including the pool. These contracts usually expire after a certain period of time, usually 12 months, which is 1 year, and they are not mandatory for a homeowner to buy in order to qualify for a mortgage. A homeowner warranty covers issues and problems that result from poor maintenance and inevitable wear and tear on the system, situations in which homeowners insurance does not apply. Homeowners insurance versus mortgage insurance. A homeowner insurance policy also differs from the mortgage insurance. The mortgage insurance is typically required by the bank or mortgage company for home buyers making a down payment of less than 20% of the cost of the property. The Federal Home Administration also requires it of its taking of the FHA loan. It is an extra fee that can be figured into regular mortgage payments or a lump sum charged when the mortgage is issued. Mortgage insurance covers the lender for taking on the extra risks of a home buyer who doesn't meet the usual mortgage requirements. If the buyer should default on payments, the mortgage insurance would compensate. Basically, why both deal with residents, homeowner insurance protects the owner and the mortgage insurance protects the mortgage lender. Homeowners insurance, that is home insurance, is not a luxury, it is a necessity. And not just because it protects your home and possessions against damage or theft. Virtually all mortgage companies require borrowers to have insurance coverage for the full or fair value of their property, usually the purchase price, and won't make the loan or finance a residential real estate transaction without proof of the homeowner's insurance. Listen carefully, you don't have to own your own home to need the insurance. Many landlords require their tenants to maintain renters insurance coverage, but whether it is required or not, it is smart to have this kind of protection. We'll walk you through the basic homeowners insurance policy. What does a homeowner insurance policy provide? Although there are different customizable ones, a homeowner insurance policy has certain standards that you must provide that will cost the insurer will cover. First of all, we have damage of the interior or the interior of your house. In the event of damage due to fire, hurricanes, lightning, vandalism, or other covered disasters, your insurer will compensate you so your house can be repaired or even completely rebuilt. Destruction or mutilation from floods, earthquake, and poor home maintenance is generally not covered, and you may be required to get separate riders if you want that kind of protection. Freestanding garage, sheds, or other structures on the property may also need to be covered separately using the same guideline for the main house. Clothing, furniture, appliances, and most of other contents of your home are covered if they are destroyed in an insured disaster. You can even get off-premises coverage if you could file for a claim for lost jewelry, say no matter where in the world you lost it, and there may be a limit on the amount your insurer will reimburse you. However, according to the Insurance Information Institute, most insurance companies will provide coverage for 50 to 70% of the amount of insurance you have on the structure of your home. For example, if your house is insured for $200,000, there would be amount of $140,000 worth of coverage for your possessions. If you own a lot of high-priced possessions, find out